Hey guys, Jordan from Precondo here. Today I want to talk about the two current best developments in the city of Toronto to invest in the pre-construction market. It's a question I get asked more frequently than any other question is, hey Jordan, I'm looking to invest in the pre-construction market. I don't really know where to go. Not specific on neighborhood, just looking for the best value, best long-term growth. And week to week, month to month, my answer to this question will change as inventory changes, as new condos launch, and as older condos sell out. But currently, I have two really good picks for the month of November, 2019, and these two are selling rather quickly. So the window is short, but I'm going to share my screen with you and show you how I walk through one of these analysis, how I figure out if it's a good purchase or not. That way you can do the due diligence yourself in the future, and I'm going to continue to put one of these out every month. So without further ado, the two developments first is Reunion Crossing in the Junction, and the second is 900 St. Clair in the Hillcrest, sort of St. Clair West Village neighborhood. So why these are good investments? Well, first off is they're both in very good neighborhoods, up-and-coming neighborhoods, redeveloping neighborhoods that we're going to see a lot of growth in over the next few years to decade. And they're also priced below market value, which is incredibly difficult to find in pre-construction. Only 1 in 10 developments ever fall below the resale market value. And it's been that way in Toronto for a long time. So despite the popular myth, pre-construction has never been cheaper than resale. Pre-construction always launches more expensive than resale. That's just the way it is. But every once in a while, a project doesn't increase their prices while the market continues to trend up. And you get this sort of gap reversal where suddenly it becomes a better purchase to buy pre-construction than resale. Usually this doesn't last very long. The window of opportunity is short. And again, it's maybe 1 out of every 20 developments. Most developments, half of the developments sell out before they even get to this opportunity. But in the case of these two developments, Reunion Crossing and 900 St. Clair, this opportunity exists. So Reunion Crossing, you can buy at $822 per square foot in the Junction neighborhood. The Junction neighborhood, if you're not familiar, is very up and coming. It's, in my opinion, undervalued. It's very well connected by transit, and Reunion Crossing happens to be right on St. Clair, so you're right on the St. Clair streetcar. It also happens to be right next to a SmartTrack GO stop, which we'll come to in a moment. 900 St. Clair is in the Hillcrest neighborhood. It's a more built-up neighborhood. If you haven't been to St. Clair West as a neighborhood, it's sort of like there's a ton of restaurants. It's a very vibrant community. It's sort of like Bloor West. If Bloor West had streetcars, it's kind of like Bloor West if Bloor West had streetcars. You're just a little bit west from the St. Clair West station, so transit-wise, the community is very, very accessible. You can buy into 900 St. Clair at $950 per square foot. Keep in mind, you're in a nicer neighborhood than the Junction. You're sandwiched in between Wychwood and Forest Hill South, so it's a very upscale neighborhood, and like I said, a very vibrant community. So in terms of the two differences, there's reasons why I like one over the other and vice versa, but in terms of the neighborhood, figuring out that these are below market value is relatively easy to do. So the Junction, based on 4 comparable buildings, is trading resale at $830 per square foot to $881 per square foot. The 4 buildings that I used were 60 Heintzman, the Heintzman Place, 530 Indian Grove, which is the Duke condos, 1420 DuPont, and Upside Down condos, which is 812 Lansdowne. So those are all trading in between $825 and $925 up to $950 per square foot. How you can figure that out, by the way, is I use condos.ca. So you'll go condos.ca, you'll pull open their page for it, and condos.ca has gone to the hard work of gathering up all of the exact square footages for sold units, and they do the math for us, which is great, because if you were to use the Toronto Real Estate Board data, the problem is with median sale, you could look up median 1-bedroom condo selling price in the Junction area, but that doesn't tell you a whole lot, because it's an amalgamation of anything that's sold. So it includes 20-year-old condo buildings where 1 bedrooms are 900 square feet, and it's just not a very accurate depiction or indicator of where the market is today. So in order to do a more accurate assessment, you have to look at the per square foot value, right? So this building's trading at $921 per square foot. Typically, I'd come down here and find direct comparables in the recently sold or past listings section. But we don't have time for that, so I'll just tell you kind of what it works out to. It works out to $830 to $880 per square foot, conservatively, on the low end. And you can buy into Reunion Crossing for $822 per square foot. So it's priced, 5% below market value. that's a no-brainer. You're buying into instant equity. You're buying, and you don't have to speculate that the market's going to go up at all. 900 St. Clair in this particular neighborhood. 900 St. Clair has some units at 950, 975 per square foot. Most of the best layouts are about 1,000 a foot. If you look at Rise condos at 501 St. Clair, you look at 6 Parkwood, the Code condos, and you look at Nest condos at 829 St. Clair, you'll find that they trade in a range of Nest being the lowest around 925, 950 per square foot, all the way up to Rise condos, some units selling at almost 1,100 a foot. Average is 950 to 1050 a foot. Nicer units are closer to the top. Keeping in mind that 900 St. Clair is top of the line finishes, boutique building with less than 130 units, all 2 bedrooms and 3 bedrooms, end user targeted product, a luxury product. Likely it would trade to the higher of that. So being able to get in 900 St. Clair at 950 a foot is right in line with market value, if not a little bit of a discount versus fair market value. And it's a building that, because it's boutique and because it's end user targeted, you have longevity of investment. So something interesting about that particular neighborhood is, sandwiched in between Witchwood and Forest Hill South, you've got these, 1.6 average home price. 1.6 million is the average home price. You're surrounded by multi-million-dollar homes. You're surrounded by, average, a higher than normal average household income. Basically, you have a lot of downsizers and empty nesters looking for that condo to downsize into, but the inventory just isn't there yet. So we're going to see a lot of redevelopment along that St. Clair West Strip. That they already have some of the best restaurants in the city. It's written about in Blog TO nonstop. So it's an area that you're going to see continue to revitalize and more development will come into. So it's an area of interest. The other reason why I like 900 St. Clair a lot is just in general being end user targeted. It means the building's going to have less renters. By nature of having a lot of 2 bedrooms and 3 bedrooms, you just have less investors flooding into the building. And by having higher end finishes and all the rest of it, it also contributes to having less renters and having more end users. And what that means is, when you've got a building filled with more renters than end users, maintenance fees tend to increase quicker and values don't hold as well. When we see buildings with a demographic of more end users, more homeowners, the building tends to hold up better longer, as do boutique buildings. So you have the best of both worlds here. And this is an investment that you can hold for 10, 15, 20 years, rather than treating this condo like a commodity that has to be sold before your maintenance fees go up. This is something you can hold, refinance, reinvest. And this is something that can be held in your portfolio for a longer period of time with less risk. Now, what I like about Reunion Crossing is the Smart Track Go Station. So if you're not familiar with Smart Track, they're adding some Go stops, okay? So in between existing stops. The one we are most interested in is St. Clair Old Weston stop. This one is literally walking distance from Reunion Crossing. It is about 150, 160 meters away. That's a 4 or 5 minute walk at most. You're gonna be able to hop on the Go Station, head straight to Union Station, which is amazing because if you're someone who uses transit and keep in mind, renters look for things like this. This is going to add a lot of rental value to the neighborhood, both resale and rental. The GO train is definitely preferable to the subway. If you can get where you need to go, sure, it's less flexible, but it's quicker and more efficient, cleaner, all the things. So it is more desirable as a mode of transportation. This addition of this Go Stop is going to add a ton of value to this neighborhood. The junction already has a ton of redevelopment slated, but this is going to add more. So this is a huge benefit, and Reunion Crossing happens to be the closest. Scout is also very close, just across the street, but they literally couldn't be closer. So huge for the project, and I think they're underselling this as a huge value add, and condo values are going to go up instantly as soon as we see this station complete. In terms of cash flow, a lot of people say cash flow doesn't matter. I tend to disagree. So I think cash flow does still matter. Yes, you make more money in appreciation, and capital gain is ultimately where people are getting rich in Toronto. However, with that said, as an investor looking to grow your portfolio, you need to consider 2 things. How much negative cash flow can you carry? If you have multiple investments and they're costing you money every month to service them, how much can you realistically afford? And then how are you going to refinance to reinvest? So in the case of Reunion Crossing, this unit cash flow is positive, right? Current rental rate's $2,500 a month. Assuming 5% rental inflation by 2022, you're looking at $2,900 a month, which more than covers your monthly expenses after you add up your mortgage, your maintenance fees, and your property taxes. So In the event that this property goes up $100,000, $200,000 of value, you can refinance and reinvest that money tax-free without paying capital gains. That's huge. Normally, you would have to liquidate a property, anyways, that's huge. If it wasn't cash flow positive and it was cash flow negative by 300, well, refinancing would mean you're even more cash flow negative because you're carrying even a larger mortgage. And at a certain point, there's only so much monthly expenses you can afford to shell out every month, right? An asset carrying itself is definitely the most desirable spot to be. It's ideal. Sure, it's not a deal breaker necessarily, but it's definitely something you want to look for. If you can buy below market value with positive cash flow, it's a no-brainer. And Reunion Crossing happens to be one of those few 1 in 10, 1 in 20 projects. The other thing to keep in mind is that, in addition to your net cash flow, your something a lot of people miss is your principal's being paid down. So every month that you have a tenant in there, even if you're breaking even, you're not breaking even because each month that your tenant pays down your principal on your mortgage, your net worth is going up to a proportionate amount. And the final note I want to mention is that when you get qualified for investment property mortgages, your rental income counts against the mortgage you have to qualify for. Different banks use different formulas and different ways that they calculate the rental income, different ways that they apply it against the qualification criteria. However, at the end of the day, more rental income is better for you because it allows for more mortgage qualification. Just quickly want to show you St. Clair cash flow works out almost as well as the Reunion Crossing one. So pros and cons to both, but either is a slam dunk investment in my opinion. Both of them are able to cash flow, and both of them are in areas poised for a lot of redevelopment. One maybe has a longer term play associated with it, and the other one maybe is a little bit shorter term because there's more investors, but you can't go wrong with either one. And they're certainly cheaper than all of the comparable pre-construction in the area. And they're definitely in line with market value. So can't go wrong with either one. If you want the inventory on either, reach out to me. I'm always reachable via my email, via my cell phone number. It'll be in the link below. If you like this content, you want me to keep putting it out every month, just subscribe. Go to precondo.ca, sign up on any profile, and you'll get this on a monthly basis, okay?